Have you ever wondered what makes the markets move? I mean, really move? It's not always just about headlines or hype. There's this powerful, kind of invisible force at play. A single number that can send these huge ripples through your entire portfolio, from stocks all the way to crypto. So, let's dive in and uncover it.
So have you ever had this happen? One day, everything's flying high. The next, bam! It feels like your growth stocks and your Bitcoin are in this weird race to the bottom, moving in perfect, painful sync. What is the connection there? Why does it feel like they're all dancing to the exact same tune?
Well, the answer isn't buried in some super complex trading algorithm or a secret chat room. More often than not, the key to all this coordinated chaos, it actually starts with just one number. A number decided in one room by the U.S. Federal Reserve. And that number is at the very core of what we're breaking down today.
Okay, so let's get into it. The Fed's master switch. You can really think of the Federal Reserve as having this master switch for the whole economy. And we're not just talking about tweaking a dial here. This is about controlling the flow of money itself. And that switch, that's the interest rate.
So what is this magic number? It's called the federal funds rate. Now, on paper, it's just the rate banks charge each other for overnight loans. Sounds boring, right? But in reality, it's the fundamental cost of money for the entire financial system. Think about it. When money is cheap, it flows everywhere. When it gets expensive, that flow slows right down to a trickle.
And believe me, this rate is anything but stable. I mean, historically, it's been a total roller coaster. Just look at this chart. You've got these insane peaks back in the early 80s when they were trying to fight off inflation, and then you compare that to the near-zero rates we saw after the 2008 crisis, and again after 2020. This thing is constantly in motion.
Here's a great way to think about it. The Fed is basically using interest rates as the gas and brake paddles for the economy. Is inflation running way too hot? Bam, they hit the brakes by raising rates. Is the economy kind of sputtering and slowing down? They press the gas by lowering rates, trying to get people spending and investing again. It's this constant, delicate balancing act.
And they're not just flipping this switch for kicks, The Federal Reserve has a really specific job. It's often called their dual mandate, but honestly, it's more like a triple threat. They have to control inflation, keep employment stable, and make sure the whole financial system doesn't fall apart. So every single decision they make about rates is aimed at one of those three goals.
All right, so we've got the what and the why. Now let's dig into how this actually plays out in the real world, starting with that first, biggest ripple effect, the impact on the stock market.
Okay, this right here is the fundamental relationship you've got to get. When rates go up, two big things happen. First, a dollar that a company expects to earn, say, 5 years from now, suddenly it's worth less today. It's like a time value of money thing. And second, it just gets more expensive for that company to borrow money to grow its business. And yeah, both of those things are bad news for stock prices.
So let's break that down a little more. That discount rate thing we just mentioned. It absolutely hammers company valuations. And it's especially painful for those high-growth tech stocks. The ones whose value is almost all about the promise of huge future profits. On top of that, higher borrowing costs mean less cash for expansion, for new projects, for hiring. It slows everything down.
And look, this isn't just some textbook theory. Check out this chart of the S&P 500 from 2022 to 2023. See those vertical lines? Each one is a Fed rate hike. You can see the market's reaction is almost instant. The connection is right there, clear as day in the data.
Okay, so that's stocks, but what about crypto? I mean, it's a completely different kind of asset, right? There are no earnings, no factories, but, well, it turns out crypto might be even more sensitive to that master switch.
For crypto, it really all boils down to two things: liquidity and risk. When rates are high, money becomes expensive. There's just less cash sloshing around the system looking for a home. And when there's less cash, investors, well, they get nervous. Their appetite for taking big, speculative risks just plummets.
And here's why this is such a huge deal for crypto. An asset like Bitcoin, it doesn't produce cash flow, right? Its value depends almost entirely on new money coming in. So when higher rates suck all that speculative capital out of the system, crypto feels the pain directly. It is absolutely not a coincidence that the biggest crypto bull runs we've ever seen happen when interest rates were practically zero.
I mean, just look at the relationship on this chart. The orange line is Bitcoin's price, and the other lines are tracking interest rates. See how the major peaks and valleys in Bitcoin seem to follow the turns in rate policy? It's pretty clear the crypto market is watching the Fed's every move, trying to anticipate what's next.
All right, we've looked at stocks and we've looked at crypto. Now let's tie it all together. Because the real magic here is understanding how this all connects in one big, almost predictable chain reaction.
This slide right here, this is basically the blueprint for everything we've talked about. It's the whole chain reaction in one spot. Step 1, the Fed changes interest rates. Step 2, that change affects the amount of cash, the liquidity, in the system. Step 3, that level of liquidity then influences how risky investors are feeling. And finally, Step 4, that risk appetite is what drives the price of everything, from the S&P 500 all the way to Dogecoin. It's a 4-step ripple effect, plain and simple.
Okay, now, if you want to get a little more advanced, if you want to get ahead of the game, there's an indicator that the pros watch obsessively. It's called the yield curve.
So here's the simple way to think about it. Normally, you get paid more interest for lending your money out for a longer time, right? That makes sense. And that creates a normal upward sloping curve. But every now and then, the market gets really scared, and that curve actually flips upside down. Short-term rates become higher than long-term rates. That's what's called an inverted yield curve, and it's famous for being one of the most reliable predictors of a recession. It's basically the market's way of screaming that trouble might be just around the corner.
Okay, so with all this information, how can you actually use it? How do you go from just reacting to the headlines to maybe anticipating what's coming next? Let's get practical.
Think of this as your personal dashboard. These are the key signals you want to be monitoring. You've got the Fed's own projections for future rates. You've got the inflation data, like the CPI report. You want to watch bond yield movements, especially that yield curve we just talked about. And of course, you read the official statements that come out of the Fed's meetings. These are the clues that help you piece together what's coming next.
And this right here might be the most important takeaway of all. The market, it doesn't wait for the official press conference. It moves on whispers, on expectations, on probabilities. The whole game is about being forward-looking.
So in the end, you can think of the Federal Reserve as the conductor of the orchestra. They're the ones setting the tempo and the mood for the entire market. The question isn't really if you should be paying attention to them anymore. The real question is, now that you know this, how are you going to listen to the music?